SPOM Set C Paper 1. Risk Management. Which of the following is not a characteristics of risk? Not a characteristics of risk. A. It involves uncertainty in outcomes. It always leads to financial loss. It can be measured through probability. It can be managed through mitigation strategy, which is not a characteristics of risk. Uncertainty in outcomes, it is a risk. Measured through probability, it is a risk. Managed through mitigation strategy, it is a characteristics of risk. So B is not. So the answer is B. Which of the following correctly differentiate risk from uncertainty? A. Risk is always uncontrollable, whereas uncertainty is manageable. No. Risk can be measured statistically. Yes. While uncertainty cannot. Yes. Risk has no financial impact. No. Uncertainty always results in losses, whereas risk does not know. So the answer is B. Which risk classification considers whether risk remains after applying mitigation strategy? Risk remains after applying mitigation strategy. Op- Strategic risk, residual risk, inherent risk, operational risk. So risk remains, मतलब बचा खुचा risk, that is residual. So the answer is B. An automobile company's risk of losing market share due to emerging electric vehicle is an example of operational risk, financial risk, strategic risk, compliance risk. So the answer is C, strategic risk. Which risk management strategy involves transferring risk to a third party, such as an insurance providers? Risk avoidance, no. Risk retention, no. Risk transfer, yes. Risk mitigation, no. So the answer is C. A company installs high security firewall to prevent cyber attack. This is an example of A. Hedging, no. B. Risk mitigation, yes. Risk retention, no. Risk transfer, no. So the answer is B. Which of the following is an external risk? External risk of for a manufacturing company. Labor strikes within the factory, no. Changes in government taxation policies, outdated production machinery, no. Poor employee training program, no. So the answer is B. External risk. Which of the following correctly describes the relationship between risk classification and controllability? Internal risks are usually more controllable than external risk. Yes. External risks are always manageable with proper mitigation. No. Financial risks are never controllable. No. Strategic risks are always controllable. No. So the answer is A. An organization facing a lawsuit for environmental violence due to improper waste disposal is an example of compliance risk, strategic risk, customer satisfaction risk, financial risk. So lawsuit for environmental violation, it is compliance risk. So the answer is A. And risk management, the term risk appetite. Appetite is a risk willing to take, an organization is willing to take the risk. Risk appetite, मतलब भूख. The maximum risk an organization is willing to take. The probability of an event occurring, no. The financial impact of an event, no. The total number of risks an organization faces, no. So the answer is A. Which of the following is not a component of COSO ERM framework? Risk governance and culture, no. Risk strategy and objective settings, no. Risk expansion and market penetration. Risk information communication and reporting. No. So the which is not a component of COSO ERM framework. So the answer is C. According to ISO 31000 which of the following is the core principle around which the ERM risk management standard is established? Risk identifications and treatment, no. Value creations and protections, yes. Governance and compliance, no. Performance of optimization, no. So the answer is B. What is primary objective of defining risk appetite in an organization? To eliminate all risk associated with business operation, no. To determine the level of risk an organization is willing to accept in achieving its objective, yes. To create uncertainty in business decision, no. To establish mandatory regulation, no. So the answer is B. Which of the following is an essential step in the ISO 31000 increasing business revenue through risk exposures? No. Avoiding all business risk entirely? No. Communicating and consulting with stakeholder. Implementing financial penalties for risk taking behavior? No. So the answer is C. Under the SEBI regulation 2015, what is minimum number of members required for risk management committee? 2, 3, 4, 5. So the answer is B, 3. Which of the following is a key reason for integrating business continuity plan with ERM to increase regulatory burdens? No. To ensure a coordinated response. To ensure coordinated response to operational interruptions and risks. To eliminate the needs for board oversight, no. To focus only on financial risk, no. So the answer is B. According to G20, which of the following is a key aspect of corporate governance? Maximizing shareholders' returns at any cost, no. Avoiding compliance with regulatory bodies, no. Ensuring transparency, fairness, and accountability in corporate decision making, yes. Limiting board oversight to financial matters only, no. So the answer is C. What is the purpose of conducting scenario analysis and risk management? To predict future risks and their potential impact, yes. Eliminate all possible risk, no. To manipulate financial data for risk reporting, no. To focus only on internal operational risk, no. The answer is A. As per the Company Act, which section require director to lay down internal financial control IFC and they ensure their adequacy? So the answer is 134.5E. What does SA 315 issued by ICA primarily focus on? SA 315 assessing business profitability, identifying and assessing risk of material misstatement in financial statement, identifying and assessing risk of material misstatement in financial statement. SA 315. So the answer is B. Which of the following is a key responsibility of board of directors in risk management? Setting a strategy and high level objectives, executing daily risk mitigation, no. Auditing, no. Approving only financial risk, no. So the answer is A. What is primarily responsible for setting the tone at the top? CRO, CEO, risk manager, internal auditor, CEO. Tone at the top. Which of the following is not? Internal stakeholders in risk management, employee, managers, shareholders, regulatory authorities. Which is not an internal stakeholder? So the answer is D. Which of the following is a key role of risk manager? Risk manager. Approving the company's financial statement, no. Identifying and assessing risk within the organization, yes. Setting up internal control mechanism for audit, no. Defining risk appetite. So the key role for risk manager is identifying and assessing risk within the organization. So the answer is B. What is primary role of risk owners within an organization? Overseeing external regulatory compliance, no. Identify, assessing and mitigating a specific risk. Conducting a statutory audit, no. Handling only financial risk, no. So the answer is B. How does the CEO contribute to risk management? How? By assuming overall ownership of risk management, by focusing only on financial risk reporting, no. By approving a statutory audit report, no. By delegating risk management entirely to internal auditor. How does the CEO contribute the risk management? So the answer is A. Which of the following responsibility is not a part of risk owners rules? Assigning risk responsibility to internal stakeholder, no. Conducting independent financial audit. Implementing risk mitigation plans, monitoring and reviewing risk regularly, which is not a part of risk owners rules. So the answer is B. What is the primary function of an external auditor? Monitoring governance and control system, yes. Approving corporate risk, no. Making a strategic business decision, no. Managing the company's operational risk, no. So the answer is A.